This company looked like a massive success to the outside world. Investors admired it, governments trusted it, and the media praised it as a symbol of modern innovation. For years, it was presented as proof that technology and smart leadership could create unstoppable growth. The company's valuation exploded in a very short period of time. Large institutional investors rushed in, analysts upgraded their forecasts, and the founder was treated like a visionary who had completely reinvented the industry. Everything about the story sounded convincing. On paper, the numbers looked perfect. Revenue kept growing year after year. Profits appeared stable and predictable. Financial reports showed a clean balance sheet and a business that seemed both efficient and scalable. From the outside, there was no obvious reason to worry. But behind the scenes, the reality was very different. The company wasn't generating enough real cash from its core operations. Instead of fixing the underlying problems, it relied heavily on accounting tricks to survive. Losses were hidden using complex financial structures that few people fully understood. Bad investments were quietly reclassified as long-term strategic assets. Weak business units were presented as future growth engines. Quarter after quarter, the numbers were adjusted just enough to meet expectations. Not enough to raise alarm, but enough to keep investors confident and analysts satisfied. The illusion of success was carefully maintained. Auditors reviewed the reports, but they failed to dig deep enough. Analysts repeated the company's narrative without seriously questioning it. And as confidence grew, the stock price continued to rise, reinforcing the belief that everything was working exactly as planned. Anyone who raised concerns was ignored, dismissed, or publicly attacked. Critics were told they simply didn't understand the business model or the technology behind it. Questioning the story became risky, while trusting the numbers felt safer. As belief in the company increased, it began raising even more money. The CEO made bigger and bolder promises about the future. Expansion plans became more aggressive, and acquisitions were announced at a rapid pace. The illusion of success grew stronger with every new announcement. What made this situation especially dangerous was that warning signs were visible to anyone willing to look closely. Cash flow didn't match reported profits. Acquisitions made little strategic sense. Simple financial questions were answered with extremely complex explanations. But very few people wanted to push further. Then everything changed. A small investigation uncovered the truth. A detailed report revealed that billions of euros simply didn't exist. Not delayed, not temporarily unavailable. Just gone. Bank accounts were fake. Documents had been forged. And the core business was far weaker than anyone had imagined. The reaction was immediate. Trading was suspended. The stock collapsed almost overnight. The CEO was arrested. And investors lost nearly everything they had trusted the company with. This wasn't bad luck. It was fake success built on numbers nobody properly checked. And the most uncomfortable part is this. Many intelligent people suspected something was wrong. But no one wanted to be the first to say it out loud. If something looks too perfect, it probably is. And that's how this company went from superstar to zero. What makes cases like this even more dangerous is how normal they seem while they are happening. Everything looks professional. Reports are polished. Experts appear confident. And because nothing collapses immediately, people assume the system works. Fraud doesn't usually look like chaos at first. It looks like success that nobody wants to question. And by the time the cracks become visible, most of the damage has already been done.